And thanks, David, for having me back. And we're going to talk about options trading. A lot of people are buying options all the time. We're going to look at an alternative to simply buying options and watching them expire. We don't like to do that. So we're looking at some proprietary premium collection strategies, and you do not have to babysit your screen to make this happen. We have some pre-built option strategies with automation for risk and profit controls. We can do this with, of course, hedging strategies, directional and non-directional strategies. And we have the most unique trade alerts you have ever seen. So that's not any exaggeration. And with that said, we're talking about speculating. Of course, that's what we're doing, trying to make money as prices are moving up, down, and sideways. We're trying to profit, but there is always risk when trying to profit. So please do take a moment and read the risk disclosure. It is important. Remember that all funds committed should be risk capital, and that past performance is no guarantee of future results. And a little bit about who we are. We are Altivest. Since 1997, we have been a registered introducing brokerage firm. We have over 25 years of experience. I'm trading tens of millions of contracts over that time period. There's yours truly in the middle there of some of our colleagues on the S&P 500 options trading floor. And we are in a highly regulated industry in the futures and options industry, and as a brokerage firm, we take that seriously. We're audited yearly at least, so you can know that you're working with professionals here. And we're registered with the CFTC, members of the NFA, and we're located in California. And a little bit about myself. I've been doing this about 30 years. My name is Erik Gebhard, and I'm a graduate of USC with my business degree in business administration. I have my Series 3 license since 1991, co-founder of Altivest. And you may have seen some of our presentations over the last few years. Glad you could join us. I began in the securities industry. I had my Series 6 and 63 licenses and insurance licenses. I forgot about those. I began in mutual funds and annuities, and eventually got my Series 3 commodity futures license. Also have my Series 65 investment advisor law license as well. I think that's the name of the exam you have to pass to get that one. And I'm going to talk about these 3 barriers that we have as traders, all of us, even the ones who've been doing this many, many years. In fact, what I'm going to do now to give you a little more room on the screen, I'm going to shut down the video. I think that way you have more room to see what's on the screen. And we're going to go quickly, so there's a lot to get through. So how would you trade in this environment? Are you a day trader? Are you a stock picker? How about trading the chop in these markets, trying to sell the highs and buy the lows? Nope, we don't even try to do that, folks. I think we have a different approach that you're going to really kind of tune into here in just a minute. We'll jump into that live demo. But did you know that less than 1% of day traders are successful, at least according to some of these studies? Doesn't mean it can't be done, but let's take a look here. Here's an article called The Day Trading Pandemic. It says Charles Schwab analyzed active trading accounts over a 6-year period. Active traders substantially underperformed simple low-cost indexed funds. Active traders had the worst returns, the most active traders. Here's another study out of Taiwan. Over a 15-year period, less than 1% of the day traders consistently beat the market. Here's out of Brazil, only 3% made money. So you can see, and I'm sure we can all agree that it's not an easy thing to do. Even the professionals, active fund managers underperformed. Even over a 10-year period, 86% of active fund managers underperformed against their own benchmarks. Look at this recently. Goldman Sachs quietly lost $2.6 billion stock investing here just in the last 4 quarters. BlackRock just took a $1.7 trillion loss in the first half of this year against their $10 trillion assets under management. So that's phenomenal stuff there. But how would you actually trade in this environment? How about social media? Can you get a lot of help there? Listening to all the stars on social media, maybe people like this, maybe not. That day trader army that we all heard about during the pandemic, it says here, according to Morgan Stanley, any of the money that was made during the pandemic lockdown by this day trading army has all been given back by now. Interesting. So you don't want to end up like this with a $500,000 account down 96%. So we're going to try to help you avoid that with the tools we're going to talk about and demo. Maybe some of these professionals, these pundits on TV can help us. All these people we see interviewed all the time. Jim Cramer, March 25, he said the bear market is over. So right here at this red arrow, that's March 25. And then of course, subsequently the market dropped, I think NASDAQ dropped over 30% since the highs in November. So anyway, not a lot of usefulness there. I talked about oil. Oil is not going down. That's what he talked about, oil right here. Of course, we subsequently dropped a lot. So Cathie Wood, ARK Innovation, we think the bottom occurred January 27. Well, not exactly, kind of missed that one too. So yeah, I'm picking on these people, but I think a lot of times they deserve it. But what about jumping into crypto and just hodling, as they call it? Will that work? Well, here, 99% of customer funds lost in this one fund. Another hedge fund, bankruptcy. The two founders are missing. This is crazy. In March, they had 10 billion in assets, and now they're wiped out. So maybe that's not the answer. You don't want to just try to buy into a story and a narrative. That's really a disaster waiting to happen. So hopefully we can help you avoid that with a process. So even if you are day trading and investing, are you beating the market? Here's an article from an economist, Mark Skousen, and they ran kind of a simulation on these monkey portfolios, as they call them. And 96 of these 100 monkey portfolios were able to beat a generic cap-weighted index and outperform their benchmark by 1.7% per year. So kind of randomness is really what they're talking about. So you've got this, looks like a baboon, right? Isn't that a baboon? That might be the best fund manager of all. Now, number 3, and by the way, feel free to jump in and make comments and chat and whatnot. I may not see them right away, but we'll get to them. Tell me if you can relate to all this or not, and what you'd like to hear more about maybe later with some Q&A. But emotions, you got to control your emotions. It's difficult to do when you're trading. It can be expensive trying to convince the markets that you are correct. I think we could all agree with that. You don't want to end up with this on your tombstone, arguing with prices. So you've got this cycle, emotional cycle as you trade. You're optimistic and euphoric as you make money. Then as you're losing money, you wave that white flag of surrender and capitulation, and now you're back with some hope and optimism. But you want to avoid that roller coaster. Motley Fool says our own worst enemy is ourselves. And I think that's probably, there's a lot of truth to that. You've got confirmation and anchoring and recency bias. Won't go into every example of that, but I think this is a good one that might summarize it for us. When things are going well, we tend to think we're a genius, and that can really lead to disaster, compounding one after another with poor decisions. Now remember, algos and technology, for lack of a better word, high frequency trading, computers, whatever you want to call it, they're dominating the landscape now, and they have no emotions. Algo trading, according to JP Morgan, is 90% of the US equity volume. So that's pretty astounding. So all these big moves, that's all machine driven stuff. All these big waves and these sell-offs and these rallies that you're seeing day by day. It's not us, folks, it's the machines. That's called revolutionary trading. Here's what it used to look like. It's a video I took, don't have time to show it, but you get the idea. So here's our competition now, folks. This is what we're trading against: non-emotional, pure automation, built-in profit and risk controls. And they'll run you over. That's probably their goal, actually, is to run all of us over. So let's try to take a look at how some professional institutions might be looking at trading purely from a statistical or mathematical point of view. And let's look at insurance companies and how they might trade options. In fact, how we might trade options like an insurance company. So you would get paid premiums to assume risk. You would sell and manage time. You would insure yourself. You'd basically hedge your position. You'd be consistent and patient with your business plan. Have a process in place that favors long-term probabilities, essentially looking at math, statistics. That's all we're doing here. At least that's all we're going to do in the next few minutes here with our demo. We'll jump to that in a second. So these premium collection strategies for options, we're basically selling short options and generating base hits, trying to be consistent and patient. We want to manage our risk, expecting to have losers. Manage reward. You don't get too greedy, but you need the proper tools to make this happen. So remember, lots of base hits. You're not swinging for the fences. So these are short option strategies or premium collection. Any direction the market moves, there are strategies for that. So you're targeting a particular outcome and your risk is always going to be predetermined with these covered spreads we're going to talk about. And these are called credit spreads. Like I mentioned, they're covered or insured, predetermined risk and reward, non-directional. Now here's a key. We're looking at stock index futures options, not individual stock options. And why are we only doing this? Because first of all, an index option is less volatile than a stock option. A stock is always going to be more volatile than an index. And we have strategies for any condition with an index, a stock index, and that's not always as easy to implement with an individual stock due to volume and liquidity constraints and so forth. And then if you're trading an index, or at least following an index, then you're looking at just one market, maybe two indexes, three, not 6,000 or 7,000 different securities. So you have a large margin of error, and that's a big advantage to doing these strategies. And I'm going to show you this in just a moment, but essentially see the upper boundary here and the lower boundary on this trade. And you're looking for the underlying market, in this case, the E-mini S&P 500, to stay in that range. So first of all, let's jump into two things of the Greeks here. Simple stuff, but it can be very, very convoluted and cumbersome if you get into like the multiple derivatives and the what do they call it, the deep into the weeds with the Greeks. But the delta, it's how much does the option value change with a change in the underlying asset. So that's really a reflection of how delta is calculated. It's also the probability of expiring in the money. So that's the approximate probability of an option expiring in the money. So if an option's at 0.25, it means there's a 25% chance it expires in the money, but conversely, a 75% chance it does expire worthless. And keep in mind, deltas are not static. They always move up and down, moment by moment with the underlying change in the price of the asset and time as theta decay occurs. And this is important, folks. Don't get confused. Delta is not the probability of a winning trade. So keep that in mind. And theta, that's sensitivity to time. It's time decay. Remember, options are limited in their lifespan. And theta is a negative number. It equals 1 day of time decay. So here's an option premium at 10, and then theta is negative 0.05. And the next day after that, because of theta decay, you lose a day. So you lose some theta value. So now it drops to 9.95. And then after that, 9.90. All things remaining equal, of course, this just to illustrate the theta decay and what that looks like. Here's that on a graph. If you want to look at that, kind of visualize it as you approach time 0, the percent of the premium remaining drops and drops and drops. Eventually it goes to 0 theta value. So why are you only buying stock options? Well, if you are, keep in mind that the theta decay we just talked about will always work against you to some degree. You need big moves in your direction to make up for that loss of theta decay. So here's a video I found, and there's an analyst here commenting on option buyers. And she's talking about basically people that trade stock options. Says the appeal for a lot of retail investors to buy options is that they're much cheaper, but your potential for profit is actually not that high. An option spread calls for buying and selling different contracts. It's a very common way for investors to hedge risk and volatility. And it's usually cheaper because you can offset your cost by the proceeds from different contracts. So she's absolutely correct. And it's been used by Wall Street professionals for decades. That is correct. So this is interesting here. I threw this in there. In last year, 11% of Robinhood active users made options trades. And of that, fewer than 1% actually made a multi-leg options trade. That's pretty amazing, actually. So we're going to talk about multi-leg option trades. And here's an example of a call spread. You sell this red line here, that's the 45.50 call. You collect 4.5 points. You simultaneously buy what that blue line there represents is the 45.70 call, and you pay 2.25. So the net result is you collect 2.25 points, or $112.50 in this example, minus your commission. And you look for the market to stay essentially below this upper boundary here on the short call. That's kind of how that works, selling a call spread. Selling a put spread is just the opposite. In this case, selling the 36.60 put, you collect 3, you buy the 36.40, you pay out 1. The net result is down here. And again, you're looking for the market to just kind of keep its distance from your boundary here, essentially. And then Theta Decay will hopefully do its magic over time, and then you can buy that spread back for less than what you sold it for. These are not naked option strategies. Keep in mind, every position is hedged or covered, so no naked trading allowed. This animal here, is that a Sphinx cat? I think it might be, needs some fur. No naked trading allowed. There's a lot of advantages to trading covered spreads. Your risk is capped in advance, and also you don't get margin calls. And of course, there's no unlimited risk, which eventually will bite you. So avoid that. Don't have the market trading you and jerking you around. You want to be in control and not meeting margin calls and sending good money after bad. So here's an iron condor spread. It's kind of an odd name, but it's really just a simultaneous combination of that put and call spread we talked about. Here's what it looks like. You sell an out of the money call spread, collect the net premium, sell an out of the money put spread, and collect the net premium there. And you look for the underlying market to really stay within this range. Now here is our proprietary strategy. Some have called it odd and weird and other things. That's a kind of a compliment, actually. It's a variation on a condor. We call it a dragonfly. It has 6 legs, and you also collect option premium. And here it is. We'll spend just a minute on this to explain it. So let's look at the calls. You sell 4 calls, you buy 3 further out, and then 1 closer to the money. And the same structure on the puts. You sell 4, you buy 3 further out, and you buy 1 closer to the money. And I'll point out that on the puts, for example, the one you buy here is 50 points closer to the money than the 4 you sell. And same thing with the calls. This one that you buy and you own is now also 50 points closer to the money compared to the 4 that you just sold. So it completely changes the characteristics and dynamics of this trade. It's essentially you're buying insurance here and here. So you pay money for that additional insurance. And it does make a difference during certain market conditions. And you'll be glad you have a dragonfly as opposed to a condor. But of course, with everything, there's trade-offs, and we'll get into that in the demo. We have unique strategies that we can apply as well. Something we call half dragonfly spread. So the market goes sideways or decreases or even moves modestly higher. This can still work out well. It's just doing the call side of a dragonfly. Just that simple. And here's something else. We call it a bear hedge. You sell an out of the money call spread and you collect the premium, and then you use that money to buy an out of the money put spread. So it's just a debit and credit spread combined. But I know you're thinking, like Jackie Chan, how do you actually create these spreads? How do you know where to begin? What markets are you going to buy and sell? What strategy to apply? At what price? At what timing? And how do you manage that position? Sounds like it could be cumbersome and complicated. How to know where to get out for a win or a loss. Well, we have automated options technology for any market condition. It's called Theta Trader, pre-built option spreads. So Theta Trader builds the option spread for you with our proprietary algorithm, creates what we call theta trades every day. Advanced strategy automation, bull, bear, and flat market conditions. And then we have the automated risk and profit tracking, something called the risk thermal indicator. We'll show you that. So simple, effective option spreads and profit and risk management. So it is time for me to switch screens. So just bear with me, folks. Okay, so now you should be looking at my screen for Theta Trader. And if you can't see this, then I've done something wrong, but I'm sure someone will let me know. So I think you're seeing the correct screen. And you'll notice here, this section is for Theta trades, and I'll explain that in a second. Here are your open short positions or any short options or spreads and any long or bought positions. Here's your account balance, and this is basically integrated directly with your AltaVest account. This is all integrated. And then your market quotes. So you'll notice here there are bullish strategies, and they're all pre-built. And there are bearish strategies, of course, and non-directional or neutral. And keep in mind, this is just my demo account as well, so I use it for webinars like this. But a real account looks very similar. Few differences up here on the menu, but for all intents and purposes, it's the same. You'll notice the three markets we're trading: the ES or E-mini S&P 500, the E-mini NASDAQ 100, and the E-mini Russell 2000. And we'll get into the details as to why we only trade those three. But for now, let's jump into an example of a theta trade. So if you logged into your dashboard, this is what you would see. And you want to look at some dragonflies for the day on the E-mini S&P 500. So these are all pre-built. The algorithm has pre-selected these for us. Days till expiration here, 16 to 58. You'll see the expiration listed. The strike prices are pre-selected and listed here. Your maximum profit potential at expiration, and then your targeted annualized return at expiration. Keep in mind, this number here is not something you should expect to generate in terms of a return. No, we're not looking at 315% annualized returns. This number here is simply to compare one trade to another. So you can see how it varies with your days till expiration. And we'll just jump into this one. This is the September expiration on the ES. And we're going to look at a Condor here. Okay, good. Normally have a data refresh about this time, so that might be slowing things down. So here is a graph of the trade, the call spread you're selling and the put spread you're selling. And this is done simultaneously as one order. And perhaps that helps. Maybe you can see it better that way. So you'll see the market listed, days till expiration, expiration date, settlement value, the net premium collected, put risk, call risk, commission, cash required, profit potential expiration. This is your targeted return on cash, and then your targeted annualized return on this trade. And let's point out something here. The put option that is being sold has a delta of 9.74, and the call option has a delta of 6.76. So I don't know, can anyone tell me what the probability is that this put option is going to expire out of the money, at least according to the delta? You're free to jump in with any answer in the chat if you want. And same thing with the call. but quite simply, it is just over 90% probability that this put, yep, there you go, thanks Pete, that will expire out of the money. And then of course, this call, you're looking at basically 93% probability that this call option will expire out of the money. So that's why we like these types of strategies in these trades. The math and statistics and the probabilities are basically are what they are. So you'll see here that it defaults to a sell because you're selling the spread and the Condor and collecting the premium. Quantity is 1 by default. So if we jump to, you'll see the cash required, 883, and your profit potential at expiration, 116.50. And I'll keep in mind too that we are never going to hold a trade till expiration, and I'll show you that in a second. So keep that in mind, but let's jump in here and say we're doing 3 of these. You see the numbers all change. And we'll use the value here that's by default. We'll try to collect 2 3/4 on that trade and press the place button there, and our technology will handle the rest for you. And it just acts like the order's been placed and filled because it's a demo account. So let me go back and let me show you a Dragonfly. We'll just do the same market. And we'll look at the September end of month expiration. Okay, again, let's look at a graph, kind of a helicopter view here. This is what this trade looks like, the calls and the puts. And you'll notice the calls that you buy and the puts that you buy are 50 points closer to the money in this example than the 4 that you've sold. It doesn't have to be 50, but that's what the algorithm has decided for this trade on this day. Sometimes it's a little more or a little less, but you'll see here the cash required on a Dragonfly is always going to be higher than a Condor, because instead of selling 1 put and 1 call, you're selling increments of 4. It's a ratio. So if you did 2 Dragonflies, you'll see this cash required double. Watch here, just over $9,000. And again, the put that you're selling and the call that you're selling both have a 90 and 93% probability of expiring out of the money. But you'll notice the targeted return on cash and your targeted annualized return. You'll notice that, let me make that one again, it's a little bit less than the Condor. And that makes sense because we talked about it briefly. You buy this call and you buy this put, you own it. So you pay money to buy that in additional insurance. So you're paying a little bit of premium to buy some insurance and kind of create a more robust trade. So we'll go ahead and we'll jump in with a quantity of 2 of these. Leave the value here at 11 1/4 points you're trying to collect. And there you go. Just assumes we're filled, of course, for the sake of the demo. Now, let me jump in here. This is a really great functionality and very instructive and useful. We have a trade simulator, and we're going to go backwards in time, and we're going to see how some of these trades would have played out at different points in time. And I preloaded some here. Let me switch this. Okay. So here's an iron Condor into month August expiration, July 6th of last year, and use these buttons to go forward day by day. And you see as I'm going day by day here, the days till expiration tick down. You can see the P&L on the trade's a little bit negative, and that's normal because Theta Decay hasn't really started to work. But this is all green. The RTI is our special proprietary indicator, and that means do nothing. Just sit there and watch. So we'll go ahead and use this play button. Now you can see the P&L is turning profitable. And that's because of Theta Decay. And then look at this, it turns blue. And what is blue? That means take profits and move on to the next trade. And I want to make a point that when it turns blue like this, you can automate this. Again, no screen watching, so that the orders are automatically placed for you to close out that position. So you do not have to stare at the screen and watch it and monitor it. And we'll look at a Dragonfly, July 6, 2021. and we'll just go right to the end to save some time. But again, Dragonfly turns blue, take profits and run. So that was on August 4 with 28 days till expiration. And notice on the Condor, you had to wait till August 20 with 12 days till expiration before it matured enough to take profits according to the algo at least. So just showing you one benefit to the Dragonfly, it will sometimes mature more quickly. Here's another simulator. This is one of the bear hedges. We'll just run through this real quick. You can see you've sold this out of the money call spread. You've used the money to buy an out of the money put spread, and the market moved in your favor, turned out to be nicely profitable. And oftentimes you can do this for a even money or a credit, so it doesn't cost you anything to place the trade. So that's kind of what that might look like. Here's half Dragonfly calls. We talked about that briefly, just doing the call side of a Dragonfly. And that one turned profitable very quickly, actually, with 49 days till expiration. And the algo said, get out, take your profits and move on. Here's another Condor, end of month Condor from November 2020. Quite frankly, I forget what happens here, but let's take a look. See how it turns yellow and orange? That means elevated risk. The RTI says, don't do anything, but just be aware that you have elevated risk. You can see the trade's losing money. So it's right up to that upper boundary. Imagine if you're watching it day by day, you kind of be pulling your hair out. And then it finally turns red, too much risk, get out of the trade. So that would have been a losing trade if you were following the RTI. And again, if it turns blue for a profit or if it turns red for too much risk, that can be automated so you don't have to screen watch it. Theta Trader will monitor your account for you and send those orders in to close out those trades for you. And again, let's look at another. Okay, that was the end of month December Condor, and here we'll look at the Dragonfly, see if that made any difference. So instead of a Condor, you did a Dragonfly. You're getting the same type of reaction here, elevated risk with the orange. And here you go, red, too much risk, get out. So even the Dragonfly being robust, more robust at times, didn't save us from having a losing trade. So I want to point that out. No trade strategy is infallible. If anyone tells you what they're doing is always killing it, they're lying. Here's another one. We'll just run through this here. Not exactly sure how this one plays out. Oh, there you go. So market really dropped, turned red and said, get out, too much risk. If you hang on to it, you can end up with a, market expiring, in the money and you have a max loss. So it says, get out, take your lumps and move on. However, let's take a look at how the Dragonfly performed. Look at that. It actually gave you a profit-taking signal. So that Condor we just looked at had a loss, but the Dragonfly on that same day for the same expiration actually gave you a profit-taking signal. So your order would have been placed to get that that order filled automatically when those orders are placed. Let me see here. I want to point out, let me show you here. You go under my account and you see all these different settings and so forth and menu items. I've loaded a couple. We have our daily research. I'll show you that, but here's how you do the automation. This is really a big deal in terms of how effective it is, but look how simple it is to do. Automate your risk manager, activate the profit directive, and then you save your settings. And that's all you have to do. We also have proprietary research. It's our TradeScope newsletter. It's only for Theta Trader clients and members. Provide analysis and what to look for, forward guidance on the next trades we're looking at. We do our daily trading summary here, what's happening in Asia and Europe and the US, what to look for if any trades were filled that day. Here's a great help file under the glossary section. If you want some more additional color and detail, you can look at the RTI and how that works there. I won't get into all that. But let me go back to the dashboard. And you can see, of course, all your positions at a glance right on the dashboard. And I'll also point out here that you can look at everything on one page. We don't need to go back and look at all the, but if you want to see all your open positions on one page, you can, or all the open or the closed positions, you can. And then this is how you get to the simulator. You can also do something called Trade Builder, which is, I'll just make the example here. I probably didn't mention this, I don't think, but if you want to ever modify a trade, you can. Oh, I'm sorry, I'm clicking on the wrong thing. Let's say we want to modify any particular theta trade. Let me go back here. And then in just a minute, I'm going to show you the best feature of all. You're going to love this trade alert functionality. So you can use these little tools here to modify the strikes if you want and change things. But I wouldn't recommend it because you're kind of defeating the purpose of the whole platform. So with that said, there's a brief overview of the Theta Trader dashboard and the functionality of the dashboard and how easy and simple it is to use. And let me jump just real quickly, just to point out too, I think I did earlier, but you've got all the bearish strategies here. You can just buy call spreads. You can just buy outright puts. We talked about the bear hedges. You know, here's what a August end of month bear hedge might look for. What it might look like at the moment. So you can see this graph here. So you sell this call spread and buy this put spread. Just that simple. So we can see about doing 3 of these. You do that actually at a credit for a quarter point. Anyway, so just so you can see, there's all the different flexibility in what Theta Trader can and can't do. So let me switch gears again, folks. And we're going to jump back. Let's make it easier with these trade alerts. These are quite literally 1-minute trade alerts, one-touch responsive alerts. So you simply touch accept or reject, and that's all you have to do. And let's jump into that and look at an example. These alerts are live and they're integrated with your AltaVest trading account. So you touch accept and then the order's placed. Or if you don't like it, you just touch reject and nothing happens. So here we go. This is what it looks like. Whoop. I've got a lag or something here. Hold on, folks. Looks like my screen froze, but give it just a second here. I don't think I've ever had that happen before. All right, well, for some reason that video is not working. Let me try this again. Let me do this real quick. Let me try this one. I don't know why that didn't work, but so you receive an alert with a text message, and you'll see an explanation of the trade. You'll see a graph. You'll see the amount premium you're collecting in this case. You're selling 10 of these Condors. Here's the cash required, all the data you need, and then you just touch accept, and that's it. We handle the rest. So people ask, what's the performance? We have a 12-month history available. So take a moment and read that, please, for that risk disclosure. Basically, this history of our trade alerts for the last 12 months includes all the Theta Trader trade alert recommendations. Okay, so you can see the first page here. We're not going to look at every detail, but you'll notice the green highlights are the winners. And you'll notice that basically most of the selling positions where you're selling option spreads and collecting premium, those turn out to be the winners. And if you'll notice some of the L, like here's an L and here's an L, and those are when we bought some options. So occasionally we'll do that. Or of course we might do that with a hedge, like here's a bull hedge and that lost money. Just so you'll see it kind of works the way we say it does in terms of probabilities. And we'll go to the next page here. Again, you see most of the winners are sellers, basically selling premium, collecting that premium. And again, you bought a put spread, bought a put spread, bought a put spread, bought a put spread, and those turned out to be losers. And that's okay, because our core focus obviously is on collecting and selling premium. And some of the times we buy a spread, and that's in combination with a bull or a bear hedge. So it's part of another trade too. And then look at this big string here. And then the white lines here mean the trades are not closed out yet. So there's nothing to report yet. And then here we are up to date. So that's what the trade history looks like last 12 months on those trade alerts. So let's get you started with the Theta Trader membership. If you think this is a great fit for you, Theta Trader software includes all the Theta trades, the RTI, the risk thermal indicator, the trade simulator. That software is valued over $3,500. Then, of course, you just saw the trade alerts, how easy those are to use. They're integrated with your AltaVest trading account. We call those live alerts. You simply touch accept, and the order is transmitted through our technology. Just that simple. Those alerts valued over $4,400. So the Theta Trader software with the alerts are valued at over $8,000. And you have a private coach. So that would be something very, very unique to probably what a lot of you are experiencing with your trading now. A Theta Trader software includes experienced Series 3 licensed people to work with you, be your co-pilot, help you discuss your history, pick out new trades. That value, I mean, way undervalued. I mean, that's really invaluable to have someone alongside you, rooting for you. I mean, we want you to succeed because you become a client for a long, long period of time. So the Theta Trader membership is the software and the alerts with the private coaching, valued over $15,500. And remember, I touched on the daily research, our proprietary research, valued over $2,900. That's exclusive to our clients only. We have online tutorials as well. That's all embedded in the software. So you have Theta Trader software with the alerts, with your coach and the research, $18,500 value. So the Theta Trader membership used to be actually almost $4,000 when we did this in person. And because we like the live events, we like doing these group events too. Anytime we do a live event like this, we try to offer a big, big discount. So we can do even better, 80% off, but it is for a limited time, $597. And that's one low payment. And that's a lifetime membership. So I want to stress that it's not a monthly thing or quarterly or whatever, or even yearly, just one-time payment for your membership, and you have access to everything we just talked about and everything that you just saw demonstrated. Here's the link to make that happen. cf.altivest.com//TR for timing research. And that is my direct phone number. I want you to take a screenshot here of this page. You've got the order form link. You've got my direct phone number. You can even email Erik, E-R-I-K, at altivest.com. So ERIK at altivest.com. This is a lifetime membership, 30-day guarantee. So really, you don't have any excuse if this is something you think that might be a good fit for what you're doing and work well with your approach to trading and investing. And I'll show you why we think it's part of a longer term investing strategy as well. Got a bit of time here, so that's good. I think I'm right on schedule. But 30-day guarantee. If you don't like it after 30 days, and with let us know. We're not going to twist your arm. So that's that simple. A few FAQs. If you want to Futures options are tax efficient. So the IRS section 1256 treats them differently than some other investments. So essentially, that means 60% of the gains are taxed at the long-term rate, which is always typically less than the individual income rate. So in this example, if you're trading individual stocks, you'd have a 12.6% return. Now, if you're doing futures options, that same example would generate a 14.64% return, a tax savings of over $2,000, simply because you're in a tax efficient environment. But do note that you also have the ease of that 1099 with your P&L, so no more itemizing. But you'll always want to consult your tax attorney or advisor for any details on that and how that works. In IRA, yes, we can do that. There might be some financial or experience requirements, so contact us. But I talk every day, it seems like, with people transferring an IRA. So absolutely, self-directed IRAs. Forbes says here, investing in alternative assets through a self-directed RIA, something to consider. Absolutely. Why the E-mini S&P 500? They're liquid, they're efficient, they're cost-effective, and they're huge. They're 2.5 times larger than all ETFs around the world. Did you know that? If anyone knew that already, say so in the chat. I'd be surprised if anyone knew that. So the average daily dollar volume compared to the SPY is almost 10 times greater. And of course, the ETFs 2.5 times greater. So the E-mini S&P 500 and the E-mini family is where you want to be, folks. 5 additional reasons: volume, liquidity, access. That means superior execution according to the CME white paper. They offer a cost savings of $4 to $15 per contract on those ES options. So you have tight bid offer spreads, large market share, you have densely packed strikes, 100 annual expirations ensure granularity and coverage. So what that means is when the algo is looking for strike prices on the spreads like puts and calls, it's going to find what it needs. Here's another set of calls and puts, another set of calls and puts, and as time goes by, it just keeps adding and laddering, keeping those trades diversified and out of the concentration risk area there. So the E-mini spreads, by the way, trade as one trade. So these Dragonflies, for example, with Theta Trader, it's done as one order, as one trade at one price. There's no legging in. If you try to do a Dragonfly with stock options, you can't do it. You have to break it up as separate orders and leg in. It's a nightmare. And here she says again, for retail stock options traders, most retail investors only have access to the most basic call and put options, and they don't have access to option spreads or other more sophisticated strategies. So she's absolutely right. You've got all those different level 1, 2, 3, and 4, and whatever in stock options. So you have access to that very, very sophisticated type of approach to spread trading that we just showed you in Theta Trader. And that's another big advantage. And of course, you can track just 1 or 2 markets, not thousands when you're doing these index options. Efficient margin use versus stocks, clear cost structure. It's not hidden from you. So remember, these are options that trade at the Globex exchange, electronic exchange. So every order, large or small, is treated equally. So there's no payment for order flow. There's no, quote, free trading. You know what I'm talking about. Payment for order flow is something you'll see in the stock trading community, stock options, but it's not free. So Robinhood says they're commission free, but it's not, because the customer orders are executed at prices inferior to other brokers' prices. She's again talking about stock options. The most popular trading apps generate a lot of revenue from the payment for order flow, and they can make more money from options than regular stock trading. So there is an incentive for them to lure investors. She's absolutely right. And that's really what ends up happening is people are saving a penny and they end up losing a nickel thinking they're trading for free. But Robinhood got fined, and I think that business model's out the window. Payment for order flow is just disguised commissions. If you want the broker to work for you, pay a commission. Nothing of value is truly ever free. That's something like maybe our grandparents would say, wouldn't it? Sound like that? So commission rates, our rates are 5.25 round turn all in. Just talked to someone about that and they were kind of confused. No, it's basically that's upfront, all in, round turn, no other fees. And here's an example of a big box brokerage firm. They charge 2.25, but that's per side. And they don't tell you that, or they don't make it really clear either that there's additional fees on top. So it ends up being higher than what we charge. So our rates are competitive. And again, everything on Theta Trader, if I didn't mention, is net of all commissions. So all the percentages and dollar figures are all net. And let's see here, performance, everyone's self-directed, of course, so people can use the app to make any kind of trade they want. What size account? Well, you saw the Dragonflies and the Condors. Each Dragonfly needs probably close to 5,000. If you want to have multiple Dragonflies and Condors, we need a minimum of 25,000 to really give it justice. You want a free membership? Absolutely. People love this offer. $100,000 account will rebate that membership. And a $50,000 to $99,999 account, you'll get 50% of that rebated. So take us up on those offers. We people really like working with us on those. So IRA, individual, joint, corporate, LLC, trust, all the above. And now why Theta Trader? Just to kind of get towards the end here, and maybe if there's a couple questions or not, that's maybe have a little time here. So why would you even need all these kind of non-correlated alternatives? Well, they may improve diversification and lower portfolio risk. And what about inflation? I think we need to hedge inflation. Look, this is from 2000. Here's the value of a dollar, and now that dollar is worth 56.9 cents. So that's picking money right out of our pockets, isn't it? GDP forecast is now negative for Q2 GDP, according to the Atlanta Fed. Conference Board, leading economic indicator, fourth consecutive month declining. Economic growth likely to slow further. Recession risk growing. Forward-looking indicators point to U.S. economic downturn ahead. High inflation, rapidly tightening monetary policy. Economic growth will continue to cool. Recession around the end of this year and early next year now likely. So probably no surprise if you've been following things closely there. How about this? Here's a forecast for the next 10 years, negative 3.3% over the next decade, according to this predictor. And that's the household portfolio allocation to equities, being a contrarian. So the correlation between the indicator and the stock market over the next decade would be minus 3.3%. Annualized. Doesn't sound good. So that indicator is, I guess, in the past, 67% accurate, kind of interesting. So we like the low correlation to alternatives, something like Theta Trader offers, strategies for any environment or even non-directional environments. So you should try to avoid large market drawdowns. I got just a couple minutes here. You want to sidestep these bear markets if you can. So here's some bear markets in the early 2000s, and then after 2008. It says here, it took 6 years after the tech crash and 5 years after the financial crisis to regain to prior highs. So there can be long periods of time, folks. Look at this here, where stocks maybe chop around and end up going nowhere with a 0% return. So keep that in mind. You don't want to just rely on buying something and holding on to it and being completely passive. And if you have these big drawdowns in your account, even a 30% drawdown, you need a 43% return to get back even. Of course, 50% drawdown, you need a 100% return and so forth, or to get real extreme. Bitcoin down 70%, you have to gain 233% to get back to even. So it could be a lost decade for that 60-40 portfolio, according to Goldman Sachs. And this here, even that 60-40 portfolio is getting clobbered this year. Equities are down. And of course, at the same time, treasury yields have gone up, meaning bond prices have dropped too. So nowhere to hide, folks. So you don't want to be like one or even two. You should at least consider having a portion of that pie of your portfolio allocated to alternatives, such as what we're doing with Theta Trader, strategies for different conditions, as we talked about. So just to wrap it up, any market condition, you've got strategies you can apply, pre-selected trades, the automated exits with the RTI, you've got those one-touch trade alerts, you saw how those work, and of course the personal coaching to kind of tie it all together. So 5 simple steps. You just complete that order form right here. You get your Theta Trader login. You'll get an email on how to open your account, and then we'll show you how to fund the account, and you can begin trading. So there is the final slide there. So you want to get on board. That does expire tomorrow night. So you have time to ask questions even after we hang up, or tomorrow we're available. And that's fine too. Let's see if there's any other comments or questions. I always get people wanting to trade from Canada, and fortunately we can't do that. Regulations say we can't, but we'd love to have you. If you're in the EU somewhere, it depends on where you are, or a foreign country, but we do have people in clients all over the world, but just in certain places, regulations make it tough for us to have clients. And let's see if there's any other questions or comments I can think about. Yeah, keep in mind the commission is all factored into all the data on Theta Trader, because people always ask about that. And we are the brokerage firm. People ask about that. AltaVest is a brokerage firm, and Theta Trader is our proprietary trading technology that we developed and we created for our customers and our clients. So you have an account with us at AltaVest just like you would with any other brokerage firm, and it's that simple. All right, and my my email, let's see here, I will put it in here just to make sure everyone's got it there. You're welcome to email me. Oh, I don't know if everyone's got that. Make that go to everyone. Okay, that went to everyone. All right, other than that, you're welcome to call me, reach out anytime. And thanks for joining me, and I'm going to wrap it up.
All right.